Good afternoon, ladies and gentlemen. Welcome to the Barometer Reading Market Update conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would like now to turn the meeting over to Mr. Nick Hamilton. Please go ahead, Mr. Hamilton.
Thank you, operator. Hi, everyone. Thanks for joining us. We thought we would push on our normal tenet of transparency and share some views in between our regular scheduled monthly conference calls. So on the call today, David Burrows, our President, Chief Investment Strategist, as well as Salman Malik, who's the Vice President, Portfolio Manager. We just thought in light of market events and some heightened volatility, we could help provide some additional context on what we see and what we're up to. So without further ado, I'll pass it over to Dave.
Great. Thanks, folks, for taking the time today. Just thought with some of the moving parts going on out there in the market, I would just give a quick revisit to strategy and positioning in the portfolios as it relates to where we are now and kind of where things are going. Let me start by reviewing quickly. Ultimately, what we're trying to do in these portfolios is use our top-down modeling to position the portfolios within themes where something's changing for the better and where we can get revaluation. Ultimately, we think you make money by being in the parts of the market that are seeing net inflows. And in our mandate, we have a ton of flexibility that allows us to be very targeted. It allows us to void certain parts of the market and, as you know, hold cash at times. So we are tactical. And what has come out of that over time, fortunately, has been some pretty good long-term numbers. And this process has worked through a whole pile of cycles, really without fail. There are times, however, that we don't look as smart as we think we are over short periods of time and transition points. But the good news is this process has kept us out of the ditch. And, to quantify that, the equity strategy going back to the beginning is a little over 15% a year over 25 years. The income strategy just over 13% a year over the last 15. And, it's worked well. The last 10 in the income strategy, around 10% a year. If we go back just over the last year, income strategies up about 10. Equity strategy certainly better than that. If we look at year-to-date across the mandates, as of the end of today, our macro global ETF fund is up about 10% on the year. The equity fund is up about 9% on the year. Long-short, about 9%. So things are going well. We have had some questions about the start to the year in the income fund, which has been really one of our big engines over the last number of years. And so I want to touch on that today. But before I do that, I want to go back and look at the other characteristics of the performance numbers. The first thing is, in both equity and income, we have over time had a fraction of the volatility of the market. Over any of the cycles, it's been anywhere from 30% to 50% of the volatility of the underlying benchmark. And probably the biggest reason any of you guys use us is we have tended to have a very low correlation to the index. So in a falling market, that's a great thing, but low correlations cut two ways. And if you are not invested along the lines of the index, there are going to be times and transitions where the groups you own may not be the groups that are performing over a short period of weeks. But in general, we've been able to get the big moves right. I think most of you know we have had a view for the last 3 years that we've entered a secular bull market for stocks and that money will and is rotating from other asset classes, specifically from fixed income, from cash. And for the domestic consumer-led economies, money's moving from emerging markets into developed consumer-led markets, especially the U.S. So that is characterized by the fact that we have seen fairly consistent multiple expansion for stocks over the last 3 years. seen some very clear themes. Now, our strategy is all about getting targeted in themes. And, in all of the presentations we've done over the last 18 months, we have pushed on the fact that in all strategies, including our income strategy, we are very equity-focused. We have been highly dividend growth-focused. We have shied away from interest rate proxies or bond proxies with the view that while we thought rates were likely to be benign, they weren't going to be much help either. And that ultimately the economy, as it slowly gets better, would benefit companies that had some economic sensitivity and that would benefit from some of the key themes. So when we came out of 2009, I think most of you know, we focused on the things that were highly predictable interest rate proxies that did well as money started to come back to risk assets, and those included utilities and telcos and pipes. From there, we became very focused in pipelines and energy infrastructure and energy as the energy boom got underway, and that fueled returns for about 3.5 or 4 years. In every set of key themes, you're going to get transition points, and last year we hit a big one. Price of oil started to fall. Our breadth models for energy reversed in July, and that started a series of iterative moves and changes in our portfolios from what had been working, energy-related, to things that would ultimately, we believe, based on our work, benefit from lower energy prices. So energy went from, I think, close to 40% of our high-income fund to about 25% by September, to about 13% by January, and really what we had left through that period was energy infrastructure. As we sit here today, the income fund has about a 4% energy weight. So these things happen in steps because the market doesn't work in a straight line. If you look early this year, we had some underperformance in the income fund because on the back of QE that was coming in Europe, rates in the U.S. dropped from 2.2 to 1.6%, and everybody rushed into interest rate proxies. So for January and early February, utilities led the market. REITs led the market until the end of February. In our work, they didn't show up. And frankly, we didn't load up in that group. Our work continued to point towards consumer, healthcare, technology, and some industrial, specifically transports and defense. Now, what's happened since the end of February, middle of February? Well, we know that rates have turned right around, gone from 1.6 back to 2.2. Utilities have had a vicious sell-off. REITs have been beaten. What is holding up? Consumer, technology, healthcare. In financials, our view over the last 3 months has been the outlook based on energy for Canada is less favorable, and the behavior of the Canadian financial stocks mirrored that, and so slowly we rotated out of Canadian financials, specifically into U.S. financials. Now again, financials underperformed early in the year as rates dropped and as money went to interest rate proxies, because of course many of the financials benefit from higher rates, like insurance companies and banks. Again, our work pointed to that being short-term noise. So when you look at the groups that work today in the market, what was among the strongest stocks? U.S. financials. So we think that there are some very clear themes in this market. And we very often are not going to jump on short-term trends. Energy sold off from August to December, and in that period we moved away. Things don't go in a straight line. Energy was one of the strongest groups in the first 6 weeks of the year. Again, that didn't show up in our work. We held a small position to see if it turned into something, but in the last 2 weeks, energy has rolled over along with the other commodities, which is consistent with the messaging we've been giving that commodities likely have entered a 10-year bear market. And in the last 10 days, gold, energy, Soft commodities like agriculture all have sold off as the dollars continue to rally. So that's forced us or put us in a position where, despite the fact that energy infrastructure has little correlation to the price of oil, to continue that move away from energy to leave us in the position we're in today, and frankly, we're still for sale in energy. So when we look at the portfolios as they sit today, we've gone through a 6-month transition from a very different portfolio to a portfolio today that is characterized by being virtually 100% equities. We continue to believe the market is setting up for higher rates. So bonds don't make a ton of sense to us. Interest rate proxies don't make a ton of sense to us. The portfolio is highly focused on dividend growth. Where a year ago the portfolio yield may have been close to 5, today it would be sort of 2.5%. So much lower dividend yield, but one with much higher dividend growth. Looks as though the average holding could give us as much as a 20% dividend growth this year. The portfolio is more focused on earnings growth, so we expect total return, yield plus capital appreciation. The portfolio today is roughly 65% focused in the U.S. And despite the fact in the income fund we lean at times towards hedging currency because we're trying to keep volatility down, we've gone further out on the limb and have virtually no currency hedge at this point. It looks as though the U.S. dollar can continue to rally, and we've had a view for some time, many of you know, that Canadian dollar is likely to continue to weaken. If you look at where our sector weights are, there's some very clear themes that we think benefit from the impact of low oil. And as many of you know, we've shown a chart for a long time that looks at the lag that it typically takes for low oil to start working its way into the real economy. We've said for some time roughly 6 to 8 months. And we're starting to see the numbers come through in employment. So when you look at the Bloomberg Index of Economic Surprise, which in the U.S. was falling over the last 3 months, it looks as though it's bottomed out and is turning higher, meaning data is starting to surprise to the upside. So we think there are like 6 key themes in this market. And our job is to get to what's coming next, not to look backwards at what has worked and try and catch bounces. So let's start with financials. The reason we own financials is for a better domestic economy in the U.S., a possibility of higher short-term rates, and better capital markets. So it doesn't mean you buy Canada, you buy the U.S., Canada being negatively impacted by oil. We have 3 types of exposure. We have U.S. banks, domestically focused, as an example, Wells Fargo. U.S. mortgage market. As the housing market gets better, they benefit. Insurance. Specifically, they benefit from higher rates and better equity markets. And third, stronger wealth management. The third area in financials is financial technology. And as an example, Davidson Henderson, where there's an estimated $100 billion that needs to be spent by U.S. financial services companies in the next 5 years. The last area is asset management. And it's not lost on all of you that if we're in a better market, management fees over time go higher and flows get better. So that is one of our major themes. It's about 20% of the portfolio. The second theme is the consumer. And we made a point that there's a very clear tie between low energy prices and the consumer, specifically lower-end retail. And we own Home Depot, which we spent lots of time talking about, Lowe's, which both benefit from an improving housing market and pent-up demand, and Target. In travel and leisure, we own Disney. The first thing people do when they have more money in their pockets is spend money on travel. Disney dividend growth has been exceedingly strong. And then we own some consumer staples because the U.S. domestic demand is strong. So very domestically focused in the U.S. The third key theme, corporations are in great shape. They do have cash to spend, but the only thing they will spend money on is productivity. So technology is obviously core there and is the biggest beneficiary of the theme toward the Internet of Things which would include software, semiconductors. Now, technology in our income portfolio is a lower weight than we have in our equity portfolios because, frankly, they are lower yielding securities, but we do have exposure. The fourth key theme is defense, specifically because it is purely U.S. domestic focused. As the power shifted to the Republicans, it looks as though a 10-year cycle of tightening budgets for defense is about to change. And after a year of trading sideways, the defense group broke out over the last 3 months. This is not a 1 or 2 month bounce. This potentially is a 10-year increased cycle in spending, and so we are invested in the leaders in defense supply, where 90% of the revenue comes from the U.S. government, the strongest credit. So there's 4 key themes. The fifth key theme is healthcare, almost purely domestically focused, and it includes pharmaceutical and biotech, healthcare management, which would include like HCA, and devices. Last year, pharmaceutical prices were up 13% in the U.S., and companies like Pfizer and Bristol Myers, big cash flow generators, are beneficiaries of that. So Medtronic in the devices and HCA and HMOs. The last key theme, what benefits the most from low energy prices, transports, as the economy gets better, traffic improves. So FedEx, United Pacific, UNP, and CNR. So this makes up the bulk of our portfolio. And we don't believe that you make money by picking up a bounce in a sector that has been in favor, like energy. We don't think you pick up a bounce in interest rate proxies when rates are trading at historic lows. Our job is to get to durable themes, and we really believe that we're there. So this portfolio has gone through a big transition over the last few months. We think that it is set to pay us a rising stream of dividends. We think that this plentiful energy theme is one that is going to last for a long time, and prices are likely to stay lower for longer. The single biggest hedge fund trade put on so far this year is to bet on a bottom in energy. And in general, we know that when there's a crowded trade like that, it doesn't often work. And it looks like it's resolving to the downside at this point. So I understand nobody likes it when the portfolio is slow off the mark. I mean, I'll remind you that the S&P is down 1% on the year. The TSX is flat. The income portfolio is slightly negative, I think maybe close to 1%. We are not far out of whack. The bond index that rallied early in the year has sold off close to flat on the year. I think it's up 1.5 or 2%. The money's going to be made as we go through the year and as these themes play out, and we're really optimistic. We've also spent a lot of time encouraging people to try and take a look at our various equity strategies where we can get pure play without any kind of yield constraint. I really would encourage you to take a look. All of the equity strategies are on wheels, 8 to 10% ahead of the index, and set up, I think, with really strong positions, all along the same themes: consumer, technology, defense, healthcare, transports, U.S. focused. The global macro ETF portfolio is long each of these, utilizing ETFs to get exposure, but on the other side is short commodities, emerging market debt, which is behaving horribly, and void of real estate. Long-short portfolio is benefiting from the fact that there are some very clear long themes and some very clear short themes. So we want to continue to try and do what you've hired us to do, follow our process. I think that our history has been, if we do that, we get results. And they don't always come in lockstep with the market, but our job is to be disciplined and follow the process. So this is where we are today. We're quite optimistic. I think in the very short run, the market is being challenged by the fact that the U.S. dollar has rallied as quickly as it has. I think that spooked some people. Specifically, I think there is concern about emerging market debt. which we're staying away from. I would encourage you to stay away from as well, and emerging market economies. Ultimately, U.S. and Europe, currency hedged, are both very attractive geographies. And mid-cap stocks are starting to behave extremely well, which is bullish, not bearish. So none of our work points to any real risk right now in the market. All of our breadth models are improving. We're quite optimistic as we go forward. And we're going to have little 3 and 5% shakes. Those, I think, are going to be opportunities to be buyers, not to be sellers. That's kind of an update as to where we are